the sentiment towards the Indian market? Some say it is time to pull back.
Good morning, Haslinda, and hello to everyone. Our strategies actually are constructive on the markets, Indian markets. They have 11% upside on Nifty. But having said that, focusing on my own space, which is the financial sector, they moved it down to market weight, and we also downgraded the sector about a month back. So while we still remain constructive, there are pockets of opportunities for the investors that our strategists are saying that you got to be selective in picking and choosing what you're buying.
Why downgrade Indian banks? Are the heydays over?
So clearly, I mean, the Indian banks were in the Goldilocks period, so to speak, over the last couple of years, which was characterized by improvement in the top line, sharp improvement in return on assets, and a pickup in loan growth. We feel that now it's time that banks start to consolidate their ROAs. We expect the ROAs to start moderating somewhat over the next couple of quarters on a variety of reasons. One of which is, of course, tighter liquidity scenario that's facing the Indian banks. Second is the unsecured lending, where we feel that the credit cycle is already on. And third, the need to invest in expansion of capacity build-up to mobilize more and more deposits. So clearly, all of this is not very conducive for the top line, and investors will need to be select when it comes to picking and choosing the financial stock they need to own.
So there are areas of concern. Credit growth is a case in point. It is set to slow. How might that impact profitability at banks, you think?
So while we still believe that structural drivers are in place for the loan growth to sustain in line or higher than GDP growth in the longer term, but in the near term, we see some consolidation happening in the consumer retail space because we see that the household balance sheets are getting leveraged. And even the lenders who've grown this portfolio will need to consolidate if the credit cycle indeed plays out. That's going to impact the revenues, both at the margins as well as fee income, because these are highly remunerative product segments that banks have been growing or even the non-banks have been growing. So therefore, there will be impact to the earnings. We have slashed the earnings estimates by mid-single digits. We have gone below consensus now because we see some of these patterns play out over the next few quarters. So there will be impact to the top line first to start with. And if the credit quality worsens more than what we are expecting, there'll be impact to the bottom line as well. So clearly, this is going to be a negative connotation to the lenders' earnings over the next couple of quarters.
Rahul, how about deposit growth? We know there's intense competition in this space. How do you see banks trying to boost their growth in terms of deposits?
That's a very good question. Deposits is an important part for Indian banking system. Almost 70 to 80% of lenders' assets are funded by deposits, and the loan-to-deposit ratio, what we've seen over the last couple of years, have inched much higher. We are sitting at the peak of the loan-to-deposit ratio for the banking system, and therefore we feel that it has to consolidate. Historically, whenever the LDRs have hit the peak, it has ensued by a slower loan growth. The lenders are following different strategies. Some lenders have gone ahead and put up strong capacity build-out, so they're expanding distribution footprint. Some lenders are trying to improve the productivity. But really speaking, the correlation between the deposit market share and the branch market share in India has been very, very high to the extent of 95%. So therefore, in our opinion, banks will need to keep doing hard work of reaching out to the customer at the ground level by expanding the distribution footprint, which is there for some of the banks, but some of the banks are yet to follow that suit.